Hey New Zealand, super excited to share with you on how mortgage borrowing actually works when you're a first home buyer. Now we can work this out for property investors as well, but we're going to keep it very simple in this example. So let's get stuck in. Over here we've got a couple earning 195k as combined income. We've got 120k and 75k. And what we've done is we've removed the tax and we're just taking into account the net income. We've also removed the KiwiSaver. So altogether, in a monthly amount, the household brings in about 11,136 into their personal accounts. Now that seems to be a very high and impressive number, but this is how the bank's actually looking at your expenses. The banks categorize your expenses into 4 different categories. We've got the cost of living, for you to wake up, eat, live, breathe, eat, that sort of thing. We've got the cost of a car, which is about $250 for one car or $500 for two. It doesn't cover gas. This is more of your WAF, rego maintenance, that sort of thing. And then we've got the cost of the dependents, which is about $400 a head on average. Then what the bank does is they'll go into your statements, add up all the direct debits that are leaving your account, and those are your fixed commitments. Essentially things like future rates cost, future home insurance, your actual car insurance, your content, all that sort of stuff. So if 11,136 comes in, 3,327 goes out in this example. So what this means is that conservatively for the next 30 years when the bank is testing you for mortgage lending, they're estimating it on 768 as a weekly expense before even considering debt into the account. Now for some of you this may seem quite light and you're like, well, that's pretty cool because it's way less than what I actually spend. But here's where the testing gets interesting. So this example that I've given you is more of an average picture snapshot in the back end, but these figures are always constantly changing from Statistics New Zealand, as well as the bank's transactionary data. The bank has a great policy put in place called credit policy, which is used to determine these sort of variable expenses, but your fixed expenses are taken for what they actually are. So now the bank is going to test your mortgage. They're going to test it at 7.6%. This is called the test rate. Like if you were to build a shelf, you want to test the weight on it. It's a similar sort of concept. They'll load you up on 7.6 to ensure that you can pay the debt if interest rates reach that point. 6 months ago, this rate was 9.1% for testing. So it has come down a fair bit, meaning people can borrow more. Now this uncommitted income over here is 7,509, which is the 11,136 minus the 3,327, less the 300 that we've got here for the credit card. So this credit card is based on 3% of the limit of $10,000 being the credit card's limit. Even if you pay it in full, even if you clear it every single month before the interest gets charged, they will still assess it at 3% of the limit, sometimes 4, sometimes 4.8, depending on the bank. And it's done in a way to ensure that, look, you still have access to that credit and you could tap into that limit. So they have to test you for it. Now, the monthly mortgage repayment, or what's left over, is that if this is coming in, this is going out, and this is going out, you got 7,509 left. This on 30 years is a future mortgage repayment for a loan up to $1,063,000. So now this couple earning 195 doesn't need to borrow $1,063,000, but this is just giving you an example. This is the maximum that you could push to, but you should borrow much less and obviously look at what the future repayments would be on the rates that you get depending on your deposit, and be very mindful that you can always change houses later. Just to get your foot in the door is always good to start off with less debt than more. Now, what would the deposit be, or how do you work out what you need if the bank can lend you $1,063,000? It's very simple. We look at the approval amount and we divide it by 0.9 to give us the amount of 1.181. So this is your borrowing, $1,063,000. This is your max purchase price. That would mean that you'll need a deposit of $118,000 in this example. You add up 118 plus 1,063,000, that's your max purchase price. Now, if you go on 20% deposit, then basically you're divided by 0.8, and then you get this figure over here, 1,329, which will be the max purchase price minus your borrowing. That would mean if you have a 265K deposit, you can buy a property up to 1.329, provided you're approved for 1,063,000. So it's a pretty extreme example. And look, there's quite a few extra expenses that I've put in here, or I can put in here to be able to judge the situation for your family planning and all of that sort of stuff. But hopefully you found this helpful. Please subscribe, and if you like the content, give us some feedback. We obviously want to give stuff away for free and share as much as we can. Take care. Thank you.